G'day everybody, Alan Kohler here with your Facebook live stream this week. Great to see you, thanks for joining me. And thanks again for your patience and understanding last week. And Deb, my wife, is back home of course, and had a couple of days in hospital, and she's okay. She's thyroidless, which means she's got to take thyroxine tablets for the rest of her life, because that's what the thyroid produces. But there you are. That's what happens, and she's on the mend. So anyway, it was just great not to have to do this last week. I couldn't really do it. I needed to be with Deb and to see that she was okay, and she is now. So here we are. And I actually thought we weren't going to get here today either, because we've just got back from having to evacuate the building. Because what happens is there's a burger joint downstairs, and they're constantly overheating their fat for the chips, and it smokes, and that sets the alarm off, and then the fire brigade come and have to turn the alarm off. So we, in the meantime, have to cool our heels in the street, because the alarm is very loud, apart from anything else. So anyway, we're back in the building. The chip fat is presumably going to smoke again at some point, honestly. Today's live stream, of course, as always, is general advice only and may not be appropriate for you. So that's important to remember. Don't forget our live event coming up, Constant Investor Live at the QPO in Kew in Melbourne, March the 13th. If you haven't bought a ticket, I'd invite you to do so, because I'd love to see you there. Just to remind you, there's a panel of me and Nick Griffin of Monroe Partners, and Melinda Salento of Cedar, the economist, to answer your questions, and also to answer Tom Elliott's questions, because he's going to be the moderator. So look, I think it'll be a good night. Looking forward to seeing you there. And the other thing, of course, is our app, which was in the App Store this week. Getting quite a few downloads, and have a look, see if you can download it. I think it's well worth doing. Obviously free to download, and then all you have to do is use your normal login to log into the app as a subscriber, and you'll get access to all the content, and in particular the podcasts, which are much easier to listen to in an app environment as opposed to streaming from a website. So we're pretty happy with that, and I think you'll find it much easier to use. So let's get stuck into some questions, which we have a few of. Gary says, hello Alan, I'm new to TCI, having belatedly followed you from Eureka Report. Well, that's great, Gary. Thanks for joining. Thanks for doing that. Glad to have you on board. Recently I've received 2 proposals for capital raisings, WPL and APA. WPL being Woodside Petroleum, of course, in the form of entitlement offers. I'm just wondering what you think of this mechanism and why companies are resorting to it in the current low interest rate environment. Firstly, I think that entitlement offers are great because they're generally at a discount. I just had some notes. Just hang on, don't go away. The APA offer is at $7.70 and their share price is $7.90, so that's a 2.5% discount to the share price. You're probably investing in APA for the dividend and the yield, and it basically means you get a slightly better yield if you bought them at $7.70 in the entitlement offer. You get a 5.7% yield instead of 5.5% yield. So look, it's definitely, if you like the company and you have some money to invest, then it's a good way to go, I think. Woodside, something similar, although the discount's a little bit larger with Woodside. The entitlement offer is at $27. Share price is $28.60 or so. So that's a 5.5% discount. And that improves the yield on Woodside from 4.3 to 4.6. So look, I think entitlement offers are great for shareholders and generally should be taken advantage of. Stephen Mayne loves them. He tells me about them all the time because he reckons they're terrific. And you can actually, if you if you are happy with the amount of shares that you've got in those companies now and you don't particularly want any more, you can still take up your entitlement and sell the shares immediately and make a bit of profit. So, you know, there's a few $1,000s basically for nothing, cash, if you want, which can fund your next overseas trip. So that's another way to think about it. Just take up the entitlement and sell straight away, get the cash. It's money for nothing. So yeah, I think they're great. Why are companies doing it in the current low interest rate environment? Well, basically because they could borrow more. Obviously debt is cheaper money than equity always, but most of the time they want to, you know, there's a limit to how much they can borrow, and a lot of companies have borrowed the most that they can or want to. I interviewed Peter Coleman, the CEO of Woodside, the other day. It's on the website now. And he basically was just wanting to keep their gearing level to a certain amount so that they wouldn't lose their credit rating or have their credit rating changed. And so that's why they were doing the entitlement offer. They probably will borrow some more money, but they wanted to get some equity. I haven't spoken to APA about theirs. Yep. I just had a reminder about it as a disclaimer. Yes, I've done the disclaimer at the start, as always. Robert says, hi Alan, the company VLA that I own shares in has made a takeover offer and it's by a scheme of arrangement. Could you explain those terms and if it's better to sell shares or to sell the shares, or are there tax advantages if I hold? Not sure about the tax advantages. The scheme of arrangement basically is an agreed takeover offer, and the reason they go for a scheme of arrangement is that you don't need as many to agree with it in order to get 100%. So in a normal takeover offer, you have to get 90% acceptances in order to mop up the rest, the other 10%, so that you end up with 100%. With a scheme of arrangement, you just need to have a shareholders meeting and get 75% vote in favour, and so it's just a lower hurdle for the takeover to get to, for them to get 100%. So with the scheme of arrangement, if they get the 75% vote in favour, then the deal's done, and everybody is forced to sell, and so it's basically just a 75% vote versus a 90% vote. I mean, there are other technicalities about it, but fundamentally, it's a sale of your shares. I'm not a tax expert, but I'm pretty sure that you know, basically, however you sell your shares, whether it's on the market or in a takeover offer via a scheme of arrangement or a normal offer, it doesn't matter. You'll just have to pay capital gains tax according to the difference between your cost base and the price you get. So it's really just a question of is it better to sell the shares on the market or wait for the offer? It depends on the price, I think. And most of the time with scheme of arrangements, the board of the company, the target company, has agreed to it, so there's unlikely to be an auction and somebody else come in with a higher offer. In which case, you know, if the price is acceptable to you on the market, then you might as well take it and get your cash early. Depends on the difference between the market price and the price in the scheme of arrangement as to whether it's worth waiting for or not. Really, that's it. Kim says, I'm a construction worker with over 8 years of experience. In that time, I've spent approximately 6.5 working for labour hire agencies. Now, as you can imagine, in that time I've probably had nearly 50 separate job postings and about 6 just this year. That's kind of interesting, Kim. You're probably seeing lots of different workplaces and meeting lots of different people, so yeah, interesting. Would the job figures put me down as being employed 6 times this year, or what? The quarterly job figures are rubbery at best and not a true reflection of real full-time and part-time jobs created. With the push by employers ever going to a casual workforce and therefore not able to depend on any job security, let alone a bank loan, great for employers, not so good for employees. How would you fix the problem that presents itself with the casualisation of the workforce. Love your work. The employment data that the ABS produces is actually comes from a survey, and they survey 26,000 households every month. They ring them up, and it's 0.3%, a third of 1% of the adult population that they're surveying, and they then extrapolate from the survey. I mean, they certainly don't count you, Kim, or anyone else, unless you are part of the survey. And what they ask in the survey is, were you employed last week? And if so, for how long? So if you worked for more than 1 hour, you were employed. If less than 1 hour, you weren't employed. And then it's a question of whether you're part-time or full-time. Obviously, full-time is 37 hours or whatever. Part-time is between 1 hour and 37. So that's basically it. So you are not counted as having had 6 jobs this year, because the survey basically just asks whether those people they surveyed, that is to say those 26,000 people, did they work last week? That's it. And then they come up with the data from that. The bigger, you've raised some interesting and important points, Kim, about the casualisation of the workforce, and I don't think it's fixable, to be honest. I think that humanity is now having to deal with a big shift in the way that work operates, and really the way society operates. And nobody really knows where it's going to end or how it's going to change, what's going to happen. A lot of people are saying we need to have something called a universal basic income that'll compensate people who aren't able to get work because they've been replaced by machines. The trouble is, at the moment, is the politicians aren't really dealing with it. They're kind of still in the paradigm of that it's all about jobs, that as long as you've got a job, everything's fine. But really, I think we're starting to move into a world where it's not about whether you've got a job or not, and it's certainly not about whether you've got a full-time job. People are going to work casually, get what they can. So I think there's a lot of changes coming, and I think that I don't really have a solution. I don't think there is a solution. I think that we're going to have to adapt, deal with the changes that are occurring as they come, and society will change gradually to deal with what happens. I mean, you wouldn't be dead, fair dinkum. It's great. It's really interesting to see what's going on. It's easy for me to say I'm pretty fully employed. A lot of people are not. But look, I think that casualisation of the workforce is the right way to put it. Other people are talking about the gig economy, and that's certainly the way we're heading. And I think it's you're right to highlight it as a big change, Kim. Maria has 2 questions. You mentioned, I'll deal with them one at a time, Maria. You mentioned in your overview last Saturday that investors should steer clear of fixed interest securities for a while. Can you expand on that, please? Yeah, well, look, basically it's a pretty simple, not a particularly subtle or nuanced thing, Maria. It's really that interest rates are rising. Fixed interest rates are now rising. And that means that to the extent that it's about the holding of a tradable security, and not all fixed interest things are tradable, obviously, but bonds, for example, are, and that's to say government bonds or corporate bonds. If you're talking about those sort of fixed interest securities that are tradable, as the interest rates generally go up, prices of fixed interest securities fall. And that's because, say you hold a corporate bond or any kind of bond that's 5-year bond, and the interest rate on it is 5%, for example, just say, if the interest rate on it is 5%, that's what it is, that's what you're going to get for 5 years. if interest rates generally go up, then your 5% looks less and less valuable as time goes on, and so people will pay less for that 5% income stream, and so the price of the security goes down. And so holders of fixed interest securities that are tradable fixed interest securities will suffer capital losses. I mean, if you hold the security till maturity, say you had a 5% 10-year bond, or 5% 5-year bond, say it's a 5-year bond at 5%, you will get the 5% income stream for the 5 years, and at the end of the 5 years you'll get your money back. So if you didn't sell, that's fine. You get your money back at the end of the time. It's just that by that time, and by 3 years down the track or 4 years down the track, there'll be some other security that will pay you a better return than, or better yield, or better interest rate than 5%. So you'd be better off in something else. So really, I suppose a better way to put it would be that you're better off shortening your duration, which is really what everyone's talking about, shortening the duration. You know, so if you're in term deposits, which are not tradable, a bank term deposit, and you're in a 5-year term deposit, well, and interest rates rise, well, you're stuck at that interest rate. So you're better off having a 6-month term deposit, if that's what you're into, term deposits, because in 6 months' time interest rates will be higher and you'll be able to roll over into a higher interest rate term deposit. And so I suppose rather than say steer clear of fixed interest securities, if you're interested in fixed interest securities, probably best to shorten your duration so that you can take advantage of rising interest rates. And the reason interest rates are rising is simply that the global economy, the American economy, the Australian economy are doing quite well, and the inflation is starting to rise. And as inflation rises, interest rates must rise to compensate investors for the declining value of money caused by inflation. I hope that answers the question, Maria. If there's anything else, please put something on Facebook and I'll get stuck into that too. Second question. Last week, while the government was preoccupied with the Barnaby debacle, government slipped through a law, APRA bail-in law, that I understand puts our guaranteed deposits in banks in jeopardy. Would appreciate your feedback and your understanding of the new law. Okay, I haven't had a chance to look into that yet, Maria, so I'll have to do that either in Facebook or in the overview. I'll do it for the overview. So I appreciate you bringing it to my attention. Thank you. And I'll look at it in this week's overview on Saturday. Gavin has 2 questions. Would you be able to interview PLS, which stands for Pilbara Minerals? They have announced some large lithium offtake agreements of late, which look very exciting. And if you could dig into the financials with them, would be much appreciated. Also, could you give us your pick of top 3 lithium miners for future growth and currently looking undervalued? Not sure about the top 3, but I'll have a crack at that. I'm not sure about that. As for Pilbara Minerals, no worries, of course. Producer Greg is listening to this as we speak, and it's already going on his list. In fact, the way Greg operates, he's probably rung them already. Appreciate it if you could also try for a Bub interview. BUB, Bubs Australia, the infant formula company. Some big news for them lately with access to sales in China. Also, your thoughts if this company at current share price would be a possible target for a takeover. No idea about that. Gavin, I suppose everyone's a target for a takeover. I'm not sure, to be honest, what percentage of that company the founders still own. But, you know, a lot of people with startups like Bubs are looking for an exit, so, you know, I wouldn't be surprised if the founders bailed out at some point and took their cash going and went home. So that's probably what you're talking about, isn't it? I mean, the share price is such that they are they're in the money. Those people, they've made a bit of dough, and they probably want to cash in and head to a Caribbean island somewhere to drinking mint juleps. That'll be what they want to do. Greg informs me, and see, I forget about this. Greg informs me that, or David does, I'm not sure who's written it there, but we spoke to Pilbara Minerals in October last year. So, Gavin, check it out. If you search Pilbara Minerals on the website, you'll find the interview that I did in October. Let me know if you need that updated. But we probably, a lot of these companies will try to get back to them at least once a year, if not twice. And we've put in, we have actually asked 2 or 3 times for an interview for the people at Bubs Australia, but they seem to be a bit shy. I don't know why. Jinyesh says, what's your take on this article? And it's a piece in the Daily Telegraph about Harry Dent, or quoting Harry Dent, saying that Australian property, the headline says, financial doomsayer says Australian property prices could crash by 50% in the coming global crisis. Okay, so a couple of things to say about this, Jagnesh. Firstly, Harry Dent is flogging a book, and everyone flogging a book is trying to get attention, and the best way to get attention, particularly if you're flogging an economic book, is to say that there's going to be a crash, and everyone gives you a story, as the Telegraph did. So that's right. As for Australian property prices, what he actually said is that I think your real estate will come back 20, 30, 40, 50%. So that's what he said. So he said 20, 30, 40, 50%. So the headline's plucked out the 50, of course. That's what headline writers do. But I'm saying that there's a big difference between 20 and 50%. Now, of course, 20% fall is not immaterial. That's serious. I think we are going to get a 10% fall. And Tim Lawless, who I've interviewed this very morning, in fact, about house prices, says that history shows that the cycle is that house prices tend to fall by 10% when they fall. That's what they do. Sometimes 15. Now, 20% would be a pretty big fall, and it's possible, given that they went up a fair bit, that the fall could be in the order of 15 to 20%. That could be, that's a possibility. I think the main reason it won't, that might not happen, is that immigration remains very strong. And so therefore the demand is supportive of house prices. And also investment demand remains strong. So we've got high immigration continuing to support owner-occupied demand, and there's still, even though investment in property investment has come down in the last year or two because of clamps by APRA on the banks, it's still very strong. Tim, I can't remember what Tim said. It's something like 30% or 40% of demand for real estate in Australia is still from investors. So look, I think it's worth having a look at the interview with Tim Lawless, which will be published tomorrow as a part of the Talking Finance podcast, and also the transcript, of course. So I think it was about 7 minutes with Tim on the subject of house prices, what he thinks is going on. It was basically about what happened in February, because today's the 1st of March, and they've always got the February results, or the monthly results, at the end of the first day of the next month. And so he's talking about what they saw in February. What happened in February to national house prices was a decline of 0.1%. In Sydney it was more, I think 0.4 or 6. Anyway, Sydney is falling quite a lot, and it's already, Sydney's house prices have fallen 4% already, and clearly have some way to go. Anyway, back to Harry Dent. He has forecast about 20 of the last 2 crises, and he is correctly described as a stopped clock who is right twice a day. And so, yes, he was right. He predicted the 2008 financial crisis. That is true. However, I think he probably predicted one in 2007, 6, 5, you name it. He's always predicting crises. And so, naturally, he's eventually going to be right, because there is a crisis every now and again, and he gets to be right. The point where I agree with Harry Dent is there's still too much debt in the world. And, he pointed out in this article that we've got 57 trillion more debt, real estate, more debt now than we had before the crisis. I don't know if that figure's right, but it's certainly a lot more debt now than we had before the GFC. And so that is true. And so I think there is a problem with that. I've been writing about that in the overview. I think that this is clearly the major risk that we're facing. However, that doesn't necessarily mean that it's all going to come unstuck. And I think that, on balance, it won't. But there's definitely a risk that it might. Anyway, I'm sure Mr. Dent will sell some of his books, which is what it's all about. Oh, and Matthew asks the same thing about Harry Dent, who says he's in Australia, and even though the deadlines of his predictions of impending doom keep getting extended, he makes some interesting points about demographics, spending, and the debt-fueled asset prices boom. Do you agree with any of his analysis, or is he just another Chicken Little? Well, yes to both questions, Matthew. He is another Chicken Little, but I agree with some of his analysis. There is too much debt, and I don't really know how it's going to be dealt with. Probably just by inflation, eventually just reducing the value of it over time by reducing the value of money. We certainly need. That's why central banks are trying to get inflation back above 2%, because inflation is what reduces debt. Simply, you don't have to default on it. You don't have to pay it off. The value of money is just reduced. Asset prices go up, and everyone's happy ever after. The other points that Harry makes about demographics, I think, are correct. We're having a massive slowdown in population growth. So yeah, I mean, look, of course, a lot of what Harry Dent says is true, but then he goes to the extreme of predicting impending doom, which always gets you attention. Sandra says, many thanks for your advice. Being a novice, I like your approach. It makes sense of much that it is at times flighty. Indeed. How do you feel about Sydney airports and Transurban? We are in a good cash position at the moment, and on the surface it makes sense. Prices down 15% down from where it was, and interest rates may be looming, but they are not there yet. Was thinking to buy 5% of portfolio instead of cash bond scenario. Am not a hybrid fan. Okay, so I can't, and really don't want to give you personal advice, Sandra. It's a lot of it has to do with your own situation, which I don't know about and can't know about. I think just in general, Transurban's a fantastic business, terrific investment. I don't know what it's yielding at the moment. Let me have a look. 4.7%. 4.7% yield. Not franked, not very much franked anyway. But leaving that aside, look, it's not a bad yield. It's an expensive stock. The reason for that is that it's the tolls are generally tied to the CPI, and it's got these long-term contracts, I think it's going to be a long time before we end up with driverless cars on the road, so that there's fewer of them. Everyone keeps talking about how we're going to end up with a lot fewer cars on the road because they'll be all driverless and we'll be just taking Ubers around the place. So I reckon that's a fair way off. So I don't think their business is in any way under threat. And they're kind of expanding. There's another toll road being built in Melbourne that they are going to run. So yep, Transurban. We love Transurban, and Sydney Airport. Well, you know, it's basically a monopoly. I mean, are they ever going to build another airport at Badgers Creek? I don't know. But they've been talking about it for decades, and I reckon they'll keep talking about it for decades, and people will still keep flying into Kingsford Smith at Mascot, and I reckon Sydney Airport's a ripper. How I feel about Sydney Airport and Transurban is I feel very good about them. I think they're terrific businesses, and an investor could definitely do worse than them. Barry says, with interest rates in the USA expected to go up 4 times at 25 basis points, the US dollar will appreciate. Commodities should come down, which Aussie companies will outperform in this scenario. Yep. So, simple answer is that, well, firstly, I don't think it's absolutely certain the US dollar will appreciate. I think, you know, superficially, you're probably right. The thing against that is the twin deficits. America has a big trade deficit, and notwithstanding Trump's efforts, that was likely to continue. And it's got a big budget deficit, and that is going to expand because of the tax cuts. And history shows that when America, or any country really, but especially America, has twin deficits like this, the currency falls. And so there's going to be a tension between rising interest rates and the expanding fiscal deficit in the US, and rising deficits pulling the dollar up, the US dollar up, fiscal deficit pulling it down. My sense would be that it might not rise at all, it might go down, and if it did rise, it wouldn't be much. So I don't think it's clear that commodities are going to come down. I think the more important issue to do with commodities is China, and what happens to that economy, and you know, will they continue to meet their target of 6.5% GDP growth, and continue to build, you know, apartments and infrastructure and all the stuff, and the Belt and Road plan that they're doing. So I think that's the more important issue. I note that there was a very negative manufacturing index out of China yesterday. When I say very negative, the PMI index fell by a point, but it was the biggest fall in a while, I think, about like 6 weeks or something. So that was a bit weak. Commodity prices have been strong lately, I think. So yeah, look, I wouldn't assume, Barry, that commodity prices are going to fall. I wouldn't assume necessarily that the US dollar will appreciate. If the US dollar does appreciate, obviously companies with US dollar earnings will do well. That's the main thing to think about. So, you know, there's plenty of those. All the mining companies have US dollar earnings. CSL, clearly, and you know, a bunch of other ones. So they're the companies that sort of outperform in the scenario of rising US dollar. Andrew says, any comment on CBL Insurance and the interim liquidators and the outlook for the company? I noticed you recently interviewed its CEO from memory. Yeah, I did. It wasn't that recent. It was a little while ago. And to be honest, I don't even know what's been going on there. What's this about a liquidator? Goodness me. That's worrying. What are you talking about, a liquidator? They got a liquidator. Have they gone broke? Heavens above, I need to stay in touch. Enters voluntary administration. Look at that. That's happened just the other day. Okay. Well then, I need to keep up, don't I? I don't have any comment on it. I didn't even know they were in liquidation. I did. I'm pretty sure we did interview them. Greg's saying he's got no record of an interview with them. I'm pretty sure I did, but anyway. Andrew Hoken had them as a top stock last year, which obviously wasn't a great idea. That's for sure. So Andrew Hoken, one of our stock pickers, has done his dough on that one. Kuhn says, is Woodside's rights entitlement offer worth taking up? We published the Woodside interview yesterday. Well, again, I can't give personal advice. As I was explaining at the start of today's live stream, Kuhn, the entitlement is $27, or the offer is $27, and the share price is now $28.60 or so. So it's a good discount, 5% discount on the share price. You could actually take up the retail entitlement. You could take up your entitlement in the offer, and if you didn't want to own any more Woodside shares, you could just sell those shares that you bought for a profit and pocket the cash. So, I mean, I think it's a no-brainer, really. People should take up discounted entitlement offers because it's a free gift from the company. And companies don't give you many free gifts, so you need to take them, I reckon. David says, Hamish Douglas on Livewire says he's going to 20 to 30% cash this morning due to concerns about volatility. Given the effects on his fund, why would you not listen to him? Well, indeed. I always try to listen to Hamish, and he is a smart guy. 20-30% cash is certainly a relatively cautious percentage of cash. So he's obviously worried about things. I think there is some volatility ahead. We are having volatility. Obviously, we had it in February, and the reason I would say, without having spoken to Hamish lately, I would say the reason that he's concerned is that the market's lost a bit of confidence in how many rate hikes they're going to be this year. The market was pricing in 3 rate hikes. I think after Jerome Powell's testimony to Congress this week, they've gone to 4 rate hikes. The market has, but really nobody knows anymore. So is it 4? Is it going to be 5? Maybe it's 6. As this kind of situation unfolds, there could be some volatility. So I think there are always good reasons to listen to Hamish. I think there will be some volatility. I think that in the longer term, earnings are strong. The economies are going well. The reason that interest rates are rising by 3, 4, or 5 times this year is because of strong economic growth and rising inflation. And so the fundamental reason for rising interest rates is good news. But in the meantime, this shift in views about interest rates will probably cause some volatility. Unlike individual investors who are generally in it for long-term goals, perhaps 5 or 10-year goals, fund managers like Hamish Douglas, they're getting judged every month and every quarter. Now, you are not being judged every month and every quarter. Maybe you are, but maybe you judge yourself every month and every quarter. So you can afford to have a different approach to a fund manager like Hamish Douglas, who needs to worry about short-term volatility issues. Bubs update. The CEO of Bubs, Nicholas Sims, is in the USA till March the 13th. So we're going to attempt to secure an interview with him when he gets back to Australia. And CBL, we interviewed Carden Mulholland, the CFO of CBL Insurance, in October 2016. So that was well over 12 months ago. And the place seemed to be going fine then. they were going all right. So I don't know what's happened there. I'll have to catch up to them. But obviously we won't be able to interview Mr. Mulholland or anyone else at CBL because they'll be, well, goodness knows where they'll be, but they won't be running the business anymore because the administrators are in. Well, that's it for the questions. Today's interview, CEO interview, is Mayor Moallem, who is, as you may have gathered, Israeli, and he's one of the 16 Israeli technology stocks that's listed on the ASX, and the stock is called Sky and Space Global. Interesting business. I think it is anyway. It's they have or they're going to launch nano satellites that are about the size of this computer, a satellite like this, basically, or a shoebox. 10 kilograms of satellite, and they're going to do 200 of them. A constellation of 200 shoeboxes flying around the Earth at the equator, providing communications to African and Latin American countries. I think it's very interesting, well worth listening to. It's a very, I love these kind of interviews. You know, we do the interviews like Woodside, Peter Coleman of Woodside and so on. They're all kind of interesting too, but fascinating startups like this, sending shoeboxes into space. And the other thing today, of course, is Money Cafe, and I'm off to go talk to JK right now at the Saporito Cafe in Cavanagh Street, South Melbourne. And finally, don't forget to get your tickets for the Constant Investor Live, March the 13th. And you'll find the link on the homepage to that. Thanks for your company today. Great to see you again. Talk to you next week.